Hi, everyone. We are now looking at the second aspect within the Ind AS accounting standards context, which is accounting estimates and errors now. Friends, we have already dealt with the requirements of the changes in accounting policies and under what circumstances can we change those, right? And we also talked about, of course, is that in case there is a change in accounting policy, then in general, we do a retrospective change in that, okay? What do you want to remember here? While we, of course, want to discuss both these aspects at length, when you look at a change in accounting estimate, that has to be done on a prospective basis. And as far as the errors are concerned, it is exactly the same way we have dealt with the changes in accounting policy. So we also do a correction of errors on a retrospective basis, right? Let's talk about these in terms of the concepts, the understanding of those, and the application thereof as well, and the reason why we need to bring these on a prospective or a retrospective basis, as the case may be. Okay, when I say I'm looking at accounting estimates, we talk about the carrying amount of the assets or liabilities, right? That might be changed. There might be an adjustment required because there is a change in the circumstances. There is a reassessment of the future expected benefits or the obligations around that, and that's why a change in accounting estimate is expected, right? A lot of scenarios, a lot of instances we can imagine. We talk about let's say the calculation of bad debts, warranty provisions, inventory obsolescence, values of fair value of financial assets or liabilities, expected useful life of an asset, or the salvage value of an asset for that matter, right? So all these instances would be arising in with a change in the circumstances, changes in assumptions about the future, changes in the way we intend to, for example, just run the business, right? So all these aspects would be examples of accounting estimates, and of course changes therein may be sought. Okay, now effectively when I say, I'm talking about a very specific scenario here. Let's say there is a company X who has sold goods to company Y, right? Let's say goods worth 10 lakh rupees. Okay. Now, on the first day, it appears that everything is great. So there's no need for a bad debt provisioning required, right? But then subsequently, the seller assumes that maybe 20,000 rupees are unlikely to be recovered. Okay, so you would create, considering the prudence aspect, you would create a provision of 20,000 rupees as a bad debt, right? A provision for doubtful debt as we use it, right? But eventually you realize that with the conversations and updates from the customer, with the challenges the customer is probably facing, you now have a reason to believe that this is not 20,000 rupees, but there's a challenge with respect to 50,000 rupees now. Now, for example, the assessment of 20,000 rupees was made in the first quarter, okay, and in the second quarter, this assessment has been revisited to 50,000 rupees, right? Probably the customer was expecting some money back from his customer, and there were challenges that he was facing from the recovery of that amount. So you assume that only 20,000 are in a bad shape, so they are doubtful in terms of the recoverability, right? But gradually you understand from the customer that his further customer, his eventual customer is having a significant inability, or that customer has gone bad, and now you have a reason to believe that instead of 20,000 you would not be able to recover 50,000 out of this entire receivable of 10 lakh rupees, right? This is a classic case of a change in an estimate. Okay, now the question that you need to understand importantly, were you doing a wrong assessment here? Was it incorrect? The answer is no. You are absolutely correct when you assess that 20,000 rupees are going to be are going to be doubtful, right? But then with the updates, changes in scenario, changes in circumstances, now you have a strong reason to believe that 50,000 is not recoverable. So which means that you are correct here as well, and you were correct in the previous quarter also, right? Which suggests that you never made a mistake here. So You don't have to go back to rectify that mistake, right? You never made a wrong assumption when you assess that 20,000 is not recoverable, because the facts and the circumstances at that point in time actually suggested that 20,000 is not recoverable, right? So you were right at any point in time, while you sold the good at 10 lakh rupees, or you assumed later that 20,000 may not be recoverable, or you eventually assumed that 50,000 is not recoverable. Okay. So when you were not incorrect there, when you were not wrong there, you don't have to go back and correct anything at all. Okay. And that is what is the idea of looking at a prospective change. Now and onward, you will change your accounting, right? In this scenario, we would simply say in the quarter one, my assessment of a bad debt provision is 20,000 rupees. And in the quarter two, this is increased by another 30,000, eventually making my liability to 50,000 rupees there, right? That is what, and that is how you need to understand the aspect of accounting estimates, and the reason why a prospective change is required to be made. Okay. So effectively, we are saying that where the changes in the accounting estimates are made, you make the adjustment to the carrying values because of the reassessment of the expected benefits or obligations, and accordingly, you bring those impact in the net profit or loss in the period of the change, and also for the future period if in case the change affects both the aspects, right? Again, the easiest example you can think of is assessment of depreciation, right? If you believe that the expected life of an asset is changing, right, then not just in the current year you would make that impact, but also for future years, whatever is the remaining expected life of the asset, you would bring the changes to all those future years. For example, the impact of that change now and onward, prospective now and onward. Okay, right? Let's have a look at this instance. We'll say that a change in the estimate of the amount of a bad debt affects only the current year period, and of course is recognized in the current year altogether. This could also apply, by the way, for warranty obligations, for example, right? This could also apply to the fair value changes in the values of the assets or liabilities. Okay. But then there could be a change in the estimated life of an asset, which impacts not just the current year's depreciation, but also the forthcoming period, whatever is the remaining life of that particular asset. Okay. So the changes are made from now and onward, and that is where the reason we use the term prospective there. Okay. Provision for warranty, I think we've talked about it again. Very small example, a quick example. Let's have a look at it. It says, Beta Limited, a retail store, provides warranty for its goods sold to the customers. The company has been making a provision of 4% of its sales over the years. However, for the past 2 years, the Beta has been focused on the quality control and was able to bring down its actual expenses to 2%. Basis that it is, able to create a provision for 2%. The question is, how should Beta Limited account for this change? Now, effectively, you're talking about a prospective change, right? Now and onward, the whatever was the provision recognized so far, let's say at 4%, that needs to be brought down, right? That needs to be actualized or recognized now at 2%. So whatever is the change, or the delta as we use the term, would be brought in the current year itself. That's something which is expected to be done. That's what we're saying. The provision for warranty is an estimate indeed, and any changes are recognized prospectively. It would result in the reduction in the expenses, reduction in the liability, automatically changing the expenses in which the change is affected. And in case this also impacts a future period, if at all, that also would be done there. Okay, let's have a look at this scenario. This is pretty much the same what we have done in what we discuss in Ind AS 16, property, plant, and equipment, right? How to calculate depreciation in case the life of the asset undergoes a change, right? We're saying that MNO Limited owns a machine purchased at a cost of 20,000 rupees. management expects the life is 10 years and the residual value is expected to be 4,000 rupees. At the start of year three, there is a technological advancement, and now the management believes that the remaining life is only 4 years and there is no change in the residual value expected. The question is, what is the depreciation for the first 3 years that the entity needs to calculate? Okay, we are simply saying that the cost of the machine is given at 20,000, salvage value is given at 4,000, expected life original is given at 10 years, right? So in my year one, I would calculate my depreciation at 20,000 minus 4,000 divided by 10, that becomes 1,600, right? Which gives me my carrying value at 18,400, okay? Likewise, in the year two, I'm now saying this is 18,400 minus 4,000 divided by 9, right? That again becomes 1,600. And now I would say this is 17,000, sorry, this is 16,800 now. Okay, that's a carrying value. In the year three, however, when we say that the remaining life is only expected to be 4 years, we're talking about 16,800, which is the carrying value. This is the salvage value, right? And then divided by 4, which means 12,800 divided by 4, that gives us 3,200, which means that my depreciation now and onward, right? Current and future years would be 3,200 per annum, right? Of course, we can calculate also the carrying value remaining, which is this is 4,200, is it? Divided by, no, yeah, this is 3,200 only. So this is 16,800, which is the carrying value at start, minus 3,200, which is depreciation. That gives us 13,600 as the balance amount of the carrying value at the end of year three. All right. That's what you look at the prospective, calculations. 20,000 giving an annual depreciation of 1,600 for year one and two. But in the year three and onward, right? Now and onwards, this is my annual depreciation. That's how we start looking at the prospective adjustments because of a change in accounting estimate. Okay, right? Disclosures with respect to the changes in accounting estimates. What is the impact that it has brought in the current year and is expected to bring in the future years as well? In case it is impracticable, again, rare, but it's possible that it is impracticable to quantify the amount, then even that fact needs to be disclosed. Okay. The final piece is basically about errors, which include both intentional and unintentional errors. And when I say intentionals, I give regard to the frauds there. Okay. We are simply saying that in case there are errors which pertain to prior year and now identified, then naturally you're looking at correcting those, right? So there could be an instance that are omissions and misstatements for one or more prior periods, right? So it can also arise for an earlier period, right? There could be an error that took place 5 years ago and you only get to know about it today, right? Right. And that may arise because you have not used the accounting policies correctly, either intentionally or, by virtue of an and by overlooking those, policies. And then these errors would include the impact of mathematical errors, application of accounting policies, oversights, misinterpretations, and of course, even frauds for that matter, right? So effectively, when you look at this perspective, give regard to materiality. I think that's a fundamental, aspect that you always need to carry. The first thing that we want to remember is you can't carry errors in the systems, especially when they are material. If you get to know about those, you have to correct those. But then if these are immaterial, you may not have to bother about it again. That is not relevant for people to look at, right? So from a materiality perspective, let's have a look at this scenario. It says that the following errors occurred in the preparation of A Limited's financial statement for the immediately preceding previous year, financial year, which says that depreciation understated by an amount of 0.3% of sales, warranty provisions understated by an amount of 0.95% of sales, and allowance for bad debts, let's say to the extent of 0.85% of sales. Now, normally under the materiality definitions, and we talked about that in the conceptual framework candidly, we look at something which is, let's say, 1% of sales, or let's say 2% of assets, or 5% of profits. But then that's not a rule, again, to be very important, right? To be very, very importantly mentioning that, right? But what we're trying to say is that up to 1% may not be material, right? And that's the case, by the way. It's 0.3 and then 0.95 and 0.85. And we say individually these are not material, these are unlikely to be material, but collectively together they can influence the material economic decision of the users, and that's where they need to be corrected. There's no choice, because these are material prior period errors. Okay, so when you look at the correction, again you go back, right? You go back on the earliest prior period, restating the opening balances. You restate all those years by doing a retrospective adjustment. The way we talked about accounting policies, the same goes with the errors or the frauds, whatever you want to call it. Okay, let's have a look at this example. It says XYZ is preparing its financial statement for the year ended 31st of December 19. It will present a prior year. There's a comparative year for the year ended 31st of December 18, giving 1 year's comparative. Now, during the year, you identified that there was an error that took place in the last year. Now, how do you rectify that error? Okay, so all we are saying is we have this year 19, we also have previous year 18. There was an error that happened here. We rectify it at its source itself, right? We rectify it at its source, retrospective, right? So since it is only the last year, so there would not be any need to go back farther. Okay, that's how you start looking at the rectification of the error, right? We're simply saying an entity shall correct any prior period errors retrospectively. Of course, they need to be material in the first set of financial statements by restating the comparative amount, and in case it occurred before the earliest prior period, then you need to also bring an opening balance sheet, right? Since the error was pertaining to last year only, then the opening balance of the current year would also be restated. Nothing more than that is required to be done. Okay, let's have a look at this scenario now. It says Good Luck is preparing its financial statements for 2018-19. It presents a prior year of 1 year of 17-18, but there was an error that took place in 15-16. Now, how do you look at this error to be rectified? Now, importantly, you want to remember here is that you are in 17-18. There was a comparable period of 2016-17, right? Sorry, it's 18-19 and 17-18. My bad. 2018-19 is my current year. 2017 and 18 is the previous year. Error took place in 15-16, right? So essentially what you need to understand is that you prepare an opening balance sheet as on 1st of April 17, just prior to the earliest comparable or comparative period, right? So you prepare the opening balance sheet, which takes into impact the cumulative changes of the error once corrected or as corrected. Okay, you need to prepare the opening balance sheet as on 1st of April 17. In case this error has also an impact in the respective years 17-18 and 18-19, even these need to be restated, right? Of course, you are any which ways preparing 18-19 here, so there is no need to do that. But even if that impacts, the previous reporting period also, so even that needs to be restated, assuming the error is rectified. That's how you start looking at the consequence of a retrospective. That's how I look at the adjustments what the retrospective, changes to be made in case an error is identified there for the previous or the prior years there. Okay, right? Let's have a look at the formal solution. We say that as per Ind AS 8, any material prior period errors should be rectified retrospectively. If it pertains to a period prior to the comparative period, then the impact should be all brought into the opening balance sheet, right? Since the error pertains in for 2006, 15-16, you need to restate the opening balance sheet, for the previous comparable period, and also the opening balance sheet of the previous year itself has to be brought into the picture, right? So that's what you need to kind of look into the context, right? Let's have a look at yet another smaller example. It says that Moon Limited is in the process of preparing its financial statements for 31st of March 21. It has discovered a material error for the previous year ended 31st of March 20. It had recognized a depreciation in the P&L for 50,000, where the correct amount was 1 lakh rupees. Now, how do you deal with this, right? Essentially, in this case, all we are saying, right? You go to the previous year where you would have, the additional depreciation to be charged for the previous year, and the asset will reduce, right? Also to the extent of, that amount. So if you look at the question again, it says that you recognize a depreciation of 50,000 rupees where the correct amount was 1 lakh rupees. So you would need to recognize it basis that. Okay.